All right, well, I'm super excited to be back here for the second time, being at the inaugural event last year, and it's definitely grown in size, and really excited about the panelists that we have to kind of explore this subject, and particularly after just some of the exciting legislation news here in Alaska. So I'm going to start with just a brief introduction setting, and then folks got some material that they want to cover to kind of set the stage. But first and foremost, maybe John doesn't need introductions to this local audience here, but we do have the commissioner for the Department of Natural Resources here in Alaska, and so really excited to have him on the panel. He's leading the mission there to develop and conserve and maximize Alaska's natural resources with the public interest at heart. So we're really excited to have you on the panel, John. And then here in the middle, we've got Geoge Potts. He's come all the way from London, and so he's dealing with a little bit of jet lag in addition to a sprained wrist here, a broken arm, really. But he spent a decade in private equity and is going to bring that perspective of the carbon offset market and how we can maximize our resource base here and the potential here in Alaska. And then lastly, we've got Reg, who is actively pursuing a carbon sequestration project, and they are moving forward with permitting on their well, on ammonia plant, and so I feel like we've got a great cross-section of people that understand this business and can lend its insight, and really looking forward to the discussion between the panelists, and then also to hear what the audience wants to cover here with the Q&A. So we're going to be a little bit time constrained with a little bit late start, so we're just going to end here at 15 past the hour, but I'm sure we'll have plenty of time to cover and explore this subject in detail. So with that, maybe John, I'll turn it over to you to really set the stage for the big picture. We've got a clicker there on the podium that you might want to grab. So John's going to kind of set the big picture stage of Alaska and all the exciting opportunities that we have here, and take it away, John.
Yeah, well, good afternoon, everybody. It's great to be here today, and it's especially wonderful to be able to talk about SB 48, which just became law but a few hours ago. And yeah, thanks. And really, I'd like to thank my great team at DNR, my capable deputy commissioners, Rena Miller, my special assistant, Joe Burns, my legislative liaison, and the rest of my division directors who are really instrumental in bringing their expertise and their knowledge to bear in helping legislators understand what is a very novel and very complex subject. And so I'm really fortunate to lead such a team of capable, excellent professionals that really put us on a pathway to success. And I'm also particularly grateful for the legislature and their willingness to bear what might have seemed at times a little tedious interactions with my department as we work to really educate them and walk them through what we saw as the potential in the carbon market. So I guess to jump forward into my presentation, really what precipitated all of this was Governor Dunleavy's vision and understanding that the global carbon markets, particularly in the voluntary sector, are growing, burgeoning markets. And he was quick to connect the dots between recognizing Alaska's tremendous potential from our land holdings and our forested lands, and really our abilities to enter in this space and be a global force when it comes to looking to monetizing state resources through carbon offset projects. And as you can see on the slide, I mean, we have an incredible land base here. So my department, DNR, manages approximately 100 million acres of uplands. Tens of millions of acres of those uplands are forested. They comprise boreal forests that, of course, encompass most of the northern hemisphere. We also manage 60 million acres of submerged tidal lands. So again, the state has an incredible base upon which to look to mariculture-based carbon offset projects as well. And really what we recognize through all of this is that it really presented the state a great new source of revenue. Because historically, Alaska has had a considerable amount of logging, particularly in our southeast forests. But currently, Alaska's not really able to monetize the full potential of our forested lands. And I attribute that to a number of factors, one of which is forest management. You know, currently, our management regime for Alaska's forests are just to let nature roughly take its course. We're governed by certain constitutional principles when it comes to timber harvesting that relate to sustainable yield. So that is, we only allow loggers to harvest so much of the forest that is sort of naturally, can naturally regrow. But beyond that, we really haven't taken much ownership of our forests, and we really haven't thought through or thought much about how, if we manage our forests differently, we could get better outcomes. And it's just sort of a monetary anecdote. Last year, for instance, Alaska brought in roughly $1.5 million of timber revenue for the entire state. And if you think about that, I mean, it's a very trivial amount of money. Consequently, the state spent $120 million putting out wildfires on our state lands, and on our state forests in particular. And so there's this big disconnect between this resource that we have, our forests, and the state's ability to monetize that. And at DNR, it's our job, as was mentioned earlier, to develop the state's resources to the maximum benefit of the people. And so we really felt that this carbon piece gives the state a tool in its toolbox by which we're incentivized to more actively manage our forests, which we believe will create opportunities to monetize our forests, but also actually enable our timber industry ultimately to grow. Because if you think about managed forests, you can start thinking about managing forests for maybe certain species of trees that have more, that are more marketable. So as we replant areas that have been impacted by wildfire or insect infestation or other things like that, we can actually start replanting species that will have higher timber value at some point in the future. And once those carbon projects have gone through their life cycle, which may be 50, 60, 70, 80 years plus, at the end of that, we're left with new stands of forest then that could have tremendous value for a wood products industry. And so that's one of the elements that we're looking at. And I think a lot of you have probably heard, I mean, boreal forests really are the world's storehouses of carbon. The world has roughly 1.3 billion acres of boreal forests, and those forests absorb over 11% of the world's emitted carbon dioxide every year. And so our management and our stewardship of these forests, we feel, is key to enabling these forests to be healthy and absorb carbon and play that role in regulating our planet's atmosphere. And as a corollary to that, I wanted to throw up this slide that shows wildfires here in Alaska. On average, every year we see about 1 million acres of our forested lands burn. And of course, burning forests emit an incredible amount of carbon. Estimates for some of the wildfires recently that we've seen in Canada show that some of those boreal forest wildfires have emitted much more carbon in 1 year than years worth of the heavy oil sands production in some of those provinces. So burning boreal forests are not good overall for those that are really looking to limit carbon emissions around the world. And as you can see here in the state, last year, as I mentioned, we spent $120 million on wildfire suppression. And that was to still ultimately see 3.1 million acres of state forested lands burn. And so we have a big problem there. And so one of the visions that we have with implementing carbon offset projects on state land is really, again, managing forested lands in ways that can help mitigate wildfire danger. Because another thing that science is teaching us is that these major wildfires, particularly the ones that burn that are very intense, they can disrupt the soil chemistry and the forest soil's ability to absorb carbon. And the journal Nature had a study that they documented that showed that 90% of the combusted carbon from a North American boreal wildfire is directly related, or the release of that carbon was directly related to the soils that had been impacted following a major wildfire. And so a big portion of what we see is an opportunity here in the state is, again, looking to managing those forests and mitigating our wildfire risks. So my next slide shows potential in another area that we are very interested in progressing. Even though the bill that was recently signed deals mainly with carbon offsets on state lands, that bill has a provision that gives our Alaska Oil and Gas Conservation Commission the authority to engage with the EPA to pursue Class 6 well primacy, because we think that the state has a big role to play in the world of carbon capture, utilization, and storage. And as you can see on the map, the state has an array of geologic basins that have the right rocks, so to speak, that can trap an inordinate amount of carbon. In the Cook Inlet alone, one study that we've looked at shows that the Cook Inlet has up to, or likely over 50 gigatons worth of carbon sequestration potential in that one basin. And the Cook Inlet is just here, kind of, if you're to look through these windows as you work your way south towards the Kenai Peninsula, that's the Cook Inlet. There's myriad different sedimentary formations there. There's deep unminable coal seams and other areas that would be highly conducive for sequestering carbon. And as you know, 50 gigatons is a big amount. It's more than the nation of Japan will emit in 50 years. And so we really believe that Alaska has the potential to serve as a geologic warehouse for the world when it comes to sequestering carbon. One of our more prolific oil and gas basins, the North Slope, also has a tremendous amount of CCUS potential. In fact, it has probably the best rocks in the state to store carbon. And so as we talk about the AKLNG project, one of the great advantages or opportunities that we see are opportunities to not only sequester gas or sequester CO2 on the North Slope, but as we bring that natural gas down the pipeline to Nikiski, where it undergoes the liquefaction process, there's opportunities there in the Cook Inlet to sequester the emissions related to that activity. And as you bolt on opportunities to produce hydrogen or produce ammonia, again, those are things that ultimately you could look to sequester that carbon in that basin. And as the technology progresses, and we know that there are some successful pilots out there, we could actually foresee a future to where we could ship product like ammonia from Alaska to Asia and backhaul CO2 from Japan, from Korea, to enable those nations to reach their net zero or Paris Climate Accord benchmarks and really realize a high value chain there for the state and for those countries. And so again,
just a time check word.
Okay.
Yep.
So, you know, in a nutshell, studies by Shell and BCG show major growth in the voluntary carbon markets. The market grew 4 times from 2020 to 2021. It's forecast to grow another 5x as we move forward over the next decade. So the state participating in the voluntary carbon market, we think, will offer lots of opportunities to monetize our resource. Again, part of the reason why we're motivated to do this, companies that are operating here, particularly our energy companies, have all enunciated some form of another of net zero carbon emissions goals. And so part of our challenge and part of our opportunity here is to provide those opportunities for these companies so that as they produce energy in Alaska, they can also offset those same emissions here. And lastly, just to talk a brief amount of what this isn't. You know, we are looking for the carrot approach. So we are not implementing this program as a carbon tax on industry or on individual Alaskans. We're not setting a cap on emissions here in the state or establishing a cap and trade system. And lastly, which is really important to Alaskans, is they like to hunt and fish and ride snow machines and go out and recreate on our public lands. Lands that are dedicated to carbon offset purposes are not going to be put off limits. So people will continue to be able to camp and hunt and fish and recreate and enjoy those lands in all the same ways that they're normally accustomed to.
Awesome. Thank you, John. And so up next, just double check as we advance the slides. We should have Reg up. Just double check. And he's going to walk us through sort of, we're not seeing his slide deck. George might be doing an audible here. Might have just the order switched. Okay, yeah.
Oh, here we are. So very smoothly onto me. So Geoge Potts from Hartree Partners, where I head up climate principal investments. Intention today, give a brief intro to Hartree, what we do, our carbon business, our worldview of carbon, touch on our role that we see for offsets in the global net zero decarbonisation pathways, and talk a little bit about how you monetize carbon, and raise the spectre of what we think are some interesting, unique opportunities for the state of Alaska. So our business as a whole, founded by 3 former Goldman Sachs partners, spun out, secured backing from Oaktree Private Equity, now Oaktree's largest investment, and is a commodities merchant trading house. In the last 7 years, we've invested substantially in the energy transition. We've now got 4 gigawatts of solar in Europe. We've got gas peaking plants in the UK. We've got battery energy storage in Taiwan. We've got a bunch of port infrastructure on the east coast of the United States. And we've got a substantial carbon business, which is Hartree. So what is Hartree? I mean, fundamentally, it stems from our trading activities. Volumetrically, we are a top 3 trader in compliance and voluntary markets for the last 3 years across ICE and Expansive, the 2 largest natural capital exchanges. We have a large team of structurers and salespeople working on fixed, floating, offtakes, forward, swaps, because ultimately carbon is a kind of unique asset that has parallels with other commodities, but there's a lot of ways to get tripped up. And so you've got to have pretty deep expertise around the structuring of it to ensure that you're financing the right opportunities. Now that takes us into upstream. We've been building our portfolio there for the last 4 years, and now we've got 44 projects through direct investments, on balance sheet investments, sovereign wealth funds that we work with, that cover circa 50 million tons per annum of offset creation when our portfolio matures, and a $2 billion commitment to carbon removals and CapEx. We've also got a substantial advisory team which is advising sovereigns on their involvement in the carbon markets and major corporates. And then investments, I was brought in effectively of background in private equity to support our asset management and invest in technology companies that we feel can help us differentiate in our performance in the carbon markets and ultimately underpin their growth. So what are our overarching theses around this market that we thought worth sharing? Well, one, nature-based solutions improve forestry management, afforestation. That, for us, is the lowest cost rung of the global net zero pathway. When you look at supply stacks of how we're going to get to net zero, they are at the bottom rung, and therefore they have to be a part of it. Secondly, carbon removals, as opposed to avoidance credits, are going to become, we think, probably the minor majority in the voluntary market within the course of the next 10 years. And then finally, which we'll touch on with CCS and Reg's example, is once the intersection of technology readiness levels, the cost of compliance, and the cost of implementation and the risks around implementation of technology develops, then you will see physical decarbonization of heavy industry. And when that happens, a physical CO2 market is going to emerge, which brings us back to the storage capacity that you have in Alaska, that with our view of if you want to hit 1.5 degrees, which is already gone, but let's say you do want to hit it, that is going to create physical CO2 that volumetrically is about half of the daily crude movements today that needs to be sequestered, transported, and stored. Now that is a significant volume of a new commodity that, again, Alaska can have a substantial role in. So 3 points. We like charts because we're traders and we like the data that sits behind them, but really 3 key points that I want to bring out here is you can get at 80% decarbonization of the global economy for a cost of approximately $300 per metric ton. Now that cost is going to change depending on three key things. Firstly, carbon market prices. Market prices are either cost, i.e. the stick, the fine, the compliance scheme, or they are the carrot, the voluntary scheme. Those prices need to either escalate to encourage people to move along that curve. Secondly, technology readiness levels of CCS needs to advance, come down the curve, and that again will shift people to the right, and government subsidies. Now, that's a trifecta of things that are already happening with the likes of the IRA. And you might say, okay, well, that sounds sort of reasonably complicated in terms of what needs to happen, right? I mean, these look like curves, but in reality, they're actually bar graphs, and that is every single industry that we map to say, how much does it cost to decarbonize that industry against where the technology is at in that industry? And what you get from that is effectively a curve of saying globally, industry by country, what is it going to cost and when's it going to happen? And so you hear a lot in the carbon market saying, okay, well, carbon credits are messy, they're hard to prove, they shouldn't be used. Well, okay, let's just sort of play that line. Now that is the gray one that spikes vertically a lot more soon than the flatter line. And that gets us to 60% decarbonization at a cost of $500 per ton. Now, the most onerous scheme in the world is the EU, and that is $130 per ton fine. And at present, they're still giving away 90% of those allowances for free to industry. So to think that is socially, economically, or politically acceptable is, in our view, a non-starter. If you look at the flatter line, that is where carbon credits and the carbon markets are involved. That is a lot smoother, a lot shallower, a lot more politically acceptable. And therefore, we see a fundamental role for nature-based solutions in the future of a net zero world. Monetizing does equal measurement. Measurement equals monetizing. All of our projects adhere to best-in-class standards. We use high-quality, what we call VVBs, verification validation bodies. We just completed an investment in one this morning with Microsoft. And we also utilize bleeding-edge technology to give us insight into the risks around projects, which we see as pretty key to being sure that you can sell these credits at a premium. Now, this is slightly complicated, but I thought I'd throw it out there anyway. So under the Paris Agreement, every country set their NDC, right? Their target for what they're going to go after in terms of reducing emissions. Now, there's a way that countries can trade between one another. They can trade carbon credits between one another. When they do that, it's called an ITMO, and that carbon credit becomes an ITMO. Now, the countries that are short carbon against their targets have already started striking sovereign deals to engage in this market, Japan being a very notable one. Now, if you think of the proximity and the strategic relationships that Alaska as a state could have, it starts, in our mind, to become quite interesting to theorize, okay, if we can engage at a federal level to get approval to trade as a sovereign in effect, then in reality, these credits are going to command a significant premium over your standard offsets, your credit sales. And if you're selling to sovereigns, these are going to be at a scale that is really quite important. And so to the final slide, I think you can't really read much of that because it's so small. But it's really just worth, I think, trying to pull together the 3 strands, which is 1, the carbon markets, nature-based solutions have a fundamental role in any net zero, global pursuit of net zero that is going to be socially, politically, economically acceptable. 2, the complexity in that market is national. It's driven by TRLs, it's driven by specific industries. And that means Alaska needs to be pretty fleet of foot in deciding when to invest, where to invest, what pricing structures to use when it sells, and really be quite sophisticated when you go to market to make sure you get the most from the natural assets you have. And then finally, this physical decarbonization market, the sequestration option does present great optionality for the business, as for the state, as does the opportunity to create ITMOs, a really quite unique facet. So yeah, a bit of perspective there from as I say, a trading house involved in this market day in, day out.
That's great. Hopefully, Reg, I think we're teeing it up with your slides here next, but
yeah.
Let's
see if they show up. Oh, we are.
There we go.
Well, first I want to thank the organizers and the governor's office for the invitation to be here today. So my name is Reg Manhas. I'm the CEO of Lapis Energy. We're a Dallas-based pure-play carbon sequestration company. But I'd be remiss to say, to admit the fact that I'm born and raised in northern British Columbia, and so to fly into Anchorage yesterday, it's like coming home. So it's really great to be here. So a little bit about Lapis. So we are a small company based in Dallas, private equity backed. We are comprised of basically all oil and gas people. We are basically the guts of what was the best-in-class subsurface team from Cosmos Energy, one of the premier international explorers for oil and gas with a track record all across the world of finding major oil fields and gas fields. So the theory behind Lapis was, well, let's take all that experience, let's take all that ability to find oil and gas and turn it around and use that experience to find the best places to store carbon and demonstrate to emitters that we can do it as well or better than anybody else. We can navigate the EPA process, we can find the right sinks and deliver with all the entrepreneurial experience we've had from Cosmos, with the financial backing from Cresta. And within 5 months of our company being backed by Cresta, we had our first deal with LSB Industries in El Dorado, Arkansas, which is what I'm going to talk about today. So LSB Industries is a top 5 producer of ammonia in North America who have aspirations to become the leading kind of blue ammonia and eventually green ammonia player in the United States. Their flagship plant is an ammonia plant in El Dorado, Arkansas, so kind of southwest corner of the state, just north of Shreveport, just east of Texarkana. They produce about 450,000 tons of what we call pre-combustion process CO2, which up until now they've been venting into the atmosphere. They made a corporate commitment to decarbonize that plant, both from a corporate commitment standpoint, but also from a marketing standpoint. They think they can market their blue ammonia in Asia and receive a premium price. So they went out and asked companies to bid on a sequestration solution for this plant. Lapis was the winning company. There were 16 companies that bid for that project, and we were the successful bidder, I think based upon all the factors I talked about in terms of technical background, et cetera. Essentially, it's a very simple project. LSB has about 1,400 acres of property in terms of the plant site. The geology under that plant is such that the plume is going to remain under that plant, under that 1,400 acres of surface. The capture will take place at the plant, so it's basically going to be compression and dehydration. There'll be a half-mile pipe built, about a 6,000-foot well drilled, and you'll see here, again, it's a very technical diagram, but we are going to be drilling to the top of the Smackover in Arkansas. Very prolific, but we're going to stay out of the Smackover. We're going to inject into 4 different zones in 2 different geologic formations, one being the Cotton Valley and the other being the Houston. And the idea is we will drill to the bottom of that Cotton Valley. We will inject for 5 years into that first zone, the number 1 on that map. We'll stop. We'll move up into the next zone in the Cotton Valley. We'll inject for 5 more years. We'll stop. We'll move up, eventually making our way to the top of the Houston. What you end up having is not one plume of CO2, which stretches for a large area. You end up creating a cylinder of CO2. You keep it as tight as possible because you want to minimize the pore space. You want to minimize the area that you're accessing because of contract issues and whatnot with local landowners. And so the theory behind this project is that we believe that all that CO2 will remain under that plant site, and therefore there isn't going to be a need to go out and secure a large acreage of private land. We are accessing what we're calling a buffer zone around that plant just to ensure that there's no chance of any CO2 trespassing on anyone's pore space over time. And we have to model this over 50 years. The project itself will last for 20 years, and then there's a 50-year monitoring period that we have to model for the EPA. And you'll see on the map, we've got the plume models that are there, and it demonstrates that the plume will stay under that plant. The biggest variable in this project, well, here's a schematic of the capture facility. It's very, very simple. I mean, you've got the CO2 coming in about 97% pure. It's at atmospheric pressure. We're going to put it through an air blower, eventually then put it through 3 stages of compression, dehydrate that CO2, and then 2 more stages of compression, and then pipe it to the injection well. I mean, the biggest factor we have to really prevent is any hydration, any hydrates in that CO2. It'd be extremely corrosive, and you could destroy your well. So dehydration is the most critical element of this project. The CO2, when it goes down the hole, will be well north of 1,000 psi, so it's going to go down the hole as a semi-critical fluid. It has to remain below 3,000 feet below the surface to remain in that critical stage, fluid stage. Here's a timeline. So we signed the deal with LSB in April of last year. We spent the first year basically doing all the plume modeling to demonstrate and put together an EP application to demonstrate that that plume will stand at that plant. We understand where that plume is going to go, and then we've modeled it properly. We put our application into the EPA for a Class 6 well. It's a Region 6 office in Dallas. The application itself was 822 pages long. It's an incredibly technical application. EPA have told us that it'll take 2 years to get the initial permit, which will be the permit to construct. That'll allow us to drill the well. Then we go back to the EPA with the data from that well, and that would then hopefully allow us to actually begin injection. Overall, if things work well and the EPA cooperates, we could be injecting into the formation by mid-2025. It could slip into 2026 depending on the EPA's progress. We're very encouraged in the sense that we put the application into the EPA in early February, and within 3 weeks, we had from the EPA office the Certificate of Administrative Completeness, which I understand is a record. There are many of these applications that are 6 months to a year to get that same certificate. So no questions, no comments from the EPA. So we think we're doing something right in that regard. The way this project will work from a financial standpoint, we take the tax credits. It's basically a $85 per ton tax credit through the IRS. We will monetize that tax credit. We then pay LSB for their CO2 a fee per ton for that CO2. And that's how the economics work. I would say that in terms of economics for this kind of project, this is a very, very simple project. It's at the very low end of the cost curve, I would have to say. Ammonia is about as easy as it gets. As you move up that cost curve into natural gas processing, into post-combustion, it becomes a lot more expensive. I mean, the three factors when you're looking at these projects from an economic standpoint are the volume of the CO2 that you're going to inject, the length of pipe you're going to have to use, so how far away is the sink from the source of the emissions, and what is the capture technology required. And when you look at the categories, this project really ticks the box for all three of those. So you could call it a demonstrator project. We like to think this is commercial, and we have a niche we can demonstrate, and we can move to other ammonia plants and other biogenic CO2 sources over time using some of the credits and CDRs that George talked about in terms of how you stack not only $85, but other voluntary market credits on top of that. But that's really about it. I don't want to take up too much more time. I'm sure there's some questions. Thank you.
Yeah, it was a great overview from all of our panelists. And there's a couple of things that I was kind of taken away from your guys' conversation there. And some of the stuff that you're talking about with the subsurface trespass. Yeah. A lot of folks don't know there's not really a mechanism to unitize or force pool people in pore space for CO2 sequestration. There's a mechanism for oil and gas, for EOR, but that really doesn't exist in the lower 48 now. So part of your reason for staying in that land ownership is to basically mitigate a little bit of that, I imagine. But that's actually one of the strengths of Alaska is the subsurface ownership and the legislation that's just passed. So
it's very important. I mean, at the end of the day, we never want to end up in a situation where you're doing any kind of involuntary unitization of pore space, just like you would never want to end up in that situation in a traditional oil and gas situation. We're also active in Louisiana. We have 14,000 acres in Louisiana. We think we can store 400 million tons. That's one landowner, so it's very simple. Right. But Louisiana has a regulatory framework that would allow for eminent domain type mechanisms to take place. Arkansas just changed their law. They have a Gas Storage Act, and what they did was they just expanded the definition of gases regulated by that Gas Storage Act to include CO2 and hydrogen. That also gives, ultimately an eminent domain type of a pathway, which you hope you never want to have. But in Alaska, certainly that's a much more simpler situation.
And George, you said something that really struck me. It was kind of talking about the physical scale of the CO2 market. And thinking about it in the terms of like the volume that's moved around in the crude oil market today. Just give people a sense of scale of what CO2 sequestration needs to scale up to basically meet some of the climate objectives. And then the cost of doing it with natural carbon offsets versus not, and how much that is going to basically drive the cost up as a society. That's a fascinating sort of analog to help people picture both monetary-wise and also from a physical scale and infrastructure that needs to be built, across the world.
Yeah, absolutely. I think there's a key differentiator of the durability between nature-based and technology-based solutions, which ultimately comes down to, can you achieve geologic storage? Our modeling on what we've seen people buying so far in the market is there's about a 7-cent premium per additional year of durability that you get to the right. And so you will see this market competing at a global level. If you're in the EU and you install your CCS plants, that doesn't get you out of paying the EU $130 until you can demonstrate that CO2 is permanently sequestered in a geologic formation. And so who will be pitching against Alaska? It's going to be Northern Lights, Equinor and Shell. It's going to be Carbfix in Iceland, and it's going to be the competing Class 6 wells. And there's going to be a whole range of different factors that are going to impact the price point that people are ultimately going to have to, at least for EU operators, pay to sequester. And it almost like carbon has a kind of positive or negative price depending how you look at it in that sense. And then 45Q similarly has similar kind of obligations. So this sequestration, the logistics, the infrastructure is a fascinating place to be involved in. It's, as I said, a precursor to any net zero journey, albeit higher on the cost curve than some of the nature-based assets that already exist today.
Yeah, and John, you were those numbers you were talking about of the $1 million in the forestry revenue versus the cost of the firefighting of $100 million, and trying to flip that sort of dichotomy, if you're around, and so maybe kind of teeing that up and talking about, we've got the legislation now in place to enable success. As you think about, in 5 and 10 years' time, what are going to basically be the signals or the feedback mechanisms to understand, is Alaska winning, now that we've got some of that groundwork to enable this infrastructure in this market?
Yeah, that's a great question. I mean, those are some of the very factors that we're thinking through right now, particularly as we start to envision the framework by which we're going to promulgate our regulations. But, success to me in this field does equate ultimately to resolving that imbalance between how much it's costing us to maintain our forests versus how much we're able to monetize. And I think success could be measured by a number of metrics. One, if companies that are developing energy resources or other mineral resources here in Alaska have the opportunity to offset their emissions here in Alaska, to market themselves as net zero, I think that's a major win for the state, creating new jobs, new opportunities for Alaskans in the area of carbon and forest management, I think is a big win. And we see the availability of these carbon credits, whether it's 45Q or other incentives, is enabling other industries to move forward. So, for instance, major kelp farm developers might have an industrial application for the kelp that they're farming, but the added incentive of being able to obtain some measure of carbon offset credit for some of their activity further incentivizes and might make the economics more competitive for them as they consider making an investment up here for certain ventures like a kelp farm or other mariculture opportunities. So, in a nutshell, I think we hope and we expect to see this program play itself out and as part of manifesting itself through increased revenues for the state, but also increased economic activities across myriad different sectors in the state.
Well, George, maybe just kind of building on that a little bit. So as we think about the quality of carbon offsets or carbon sequestration, if you think about direct air capture, where you're literally scrubbing the CO2 out of the atmosphere and injecting that to geological storage, as opposed to nature-based solutions, how do you guys in your company think about that verification, and how do you basically prove that permanence when you're talking about nature-based solutions?
Yeah, nature-based predominantly historically is clipboards and guys on motorbikes filling out paperwork, which isn't great. So we've invested in a couple of satellite companies. So Earth observation technology is now enabled by the standards, and so you get a lot higher efficacy when you're looking at nature-based solutions. And so, but the sins of the past still materialize today. You still hear a story coming about a project that was initiated 15 years ago, and that's not as good as the projects that are going down now, and it doesn't have the same robust methodologies. So there is inherent variability, but there are best practice technologies out there today where you can get a lot closer to the line. There's always going to be, in a lot of projects with IFM or avoided deforestation, a counterfactual, right? Which is by necessity of being a counterfactual, you are making an assessment of something that would otherwise have happened. That will always maintain a challenge that you don't necessarily have with technology-based removal. Like, why else would you put up a DAC plant other than to sequester carbon? But it costs you $500 a ton, and it costs you a ton of water for every ton of CO2 you pull in. Is that much better? And how much power is that using? What would that power have done elsewhere? So in reality, when you get a nature-based credit and say, okay, it's $20 and I get a load of biodiversity benefits, well, do you really want $480 of sort of cost just for the certainty? And there is an interplay of forestry, timber. You can burn biomass, and if you've got CCS working, you capture the carbon, you secure it, and store it in your geologic sites, and that is a highly efficacious form of carbon capture, reliable MRV, and you can do that on a cycle that lives very happily alongside timber and good forest management. And so we see that as really quite an exciting area as well, where you get both the benefits of permanence, but also the natural living alongside those industries and supplementing them with additional income from the carbon markets.
And to Reg, just kind of bringing it back to your project, because taking something that's venting pure CO2, right, and you're just having to dehydrate it, compress it, inject it with pretty much zero transportation. I mean, you've got a lot of the best of both worlds there. Yeah. So as you think about scaling that and applying that to other industrial processes, is it permitting? Is it scale? Is it technology? Is saline aquifer going to be applied to the power industry at 4% CO2 as opposed to venting 100% CO2? How do you see that market unfolding, into other industrial processes? Does the EPA need to do something with permitting? Is Arkansas helping you guys out with permitting? How does that play together to make it successful?
Well, I think certainly, we're looking at additional projects, right? We're looking, there's still ammonia projects to go after. Certainly in Louisiana, we're also talking to natural gas power plants. We're talking to developers that are looking to decarbonize pulp and paper. It really comes down to the two big factors really are going to be how expensive is it going to be captured that CO2, how much volume. I mean, the volume drives the economics to such a degree, right? I mean, the 400,000 tons that we're going to sequester from LSB is right on the margin of economics. But you add another 100,000 tons to that, the IRR goes right up. So these are very volume-sensitive projects. The biggest thing that we could also improve upon is just certainty in terms of the permitting, certainly, right? In terms of time value of money, just the risk that you're putting at, the capital you're putting at risk, with the EPA being such an uncertain process right now. So we're hopeful that over the next few years that will improve. The Louisiana's moving down the road. They've got their hearings happening next month. By the end of June, the comments will be closed, and DNR in Louisiana is confident they're going to have primacy by the end of the year. So that'll be a big step forward as well.
Yeah, I hope that the audience really sort of feels the excitement that I feel up here, and just the amount of advancement in just 1 year is truly impressive. And it's nice to have experts like yourselves to basically discuss this, and looking forward to year 3 when hearing about your progress and advancement in these sectors, and hopefully we'll come back and have you back in Alaska. But I know John will be here, but thank you guys very much, and we'll call it a wrap. Thanks.